What's up, Better Bankers? What's up, PulseChain? It is MoteItBe, Steve. I'm back with another Better Bank video. This one's going to be a more philosophical discussion, a more theoretical discussion. I want to talk today about, there's a lot of words about sustainability I see thrown around. There's a lot of words I hear, and it occurs to me that a lot of people don't actually have an idea of how legacy money systems work. Um, so recently in the Better Bank system, we've seen some incredibly high APYs offered to depositors, in excess of 300% APY. There's been some changes. They're tightening that up, and that's no longer the case. I think the top I'm seeing now is around 150%. And that's mainly because there were some people gaming the system. They realized that they could actually reduce their exposure, thereby draining the reserves of the Better Bank system, actually forcing it to offer a higher APY and earn more with less deposits than they could with more deposits. So now they've kind of capped that in a different way that it can't be gamed. Now that you are incentivized to deposit more, the more you deposit, the more you earn in interest. But this whole time, I heard a lot of detractors, and I saw a lot of people on Twitter and X and otherwise saying, "Oh, they can't keep this up. They can't keep it up. They can't keep it up. Oh, how could they ever pay 100%? How could they even pay 50%?" And it occurred to me that they don't know how much they're actually getting screwed. And when I say getting screwed, I mean by fiat banks. So when I was young, I used to watch old movies with my dad, and there'd always be the Old West Bank. Right? There's the Old West Bank, and the burglars are outside, and they've got shovels and picks, and they're tunneling in, and maybe somebody's got a stick of dynamite. And I think a lot of people still think of banks in that way, that there's a collaboration going on where I have my money, and I'm going to put it in the bank where it's safe. I'm going to take it out from under the mattress where the moths can get to it, and I'm going to go deposit at this bank, and they'll keep it safe. They've got that fancy safe there. They've got that big vault where they're going to keep my money safe. And in exchange, they're going to lend it out to people, and they're going to make a little money. And that's just fair and fine because they keep my money safe. And that's just a little naive. That's what I thought at 6 and 7 years old. And I hate to break it to you folks, that's not what banks actually do. More accurately, there's this little thing called the fractional reserve system. And I want to talk about fractional reserve because it's a system that Better Bank mimics. And this is getting at the whole crux of why Better Bank is called Better Bank. They're doing the same kind of thing. They just do it better. So pre-COVID, for years and years, the fractional reserve system said that as a bank, if you are licensed and regulated to operate as a bank, you needed to hold a fractional reserve of 1 part out of 10. So you could lend 9 times your deposits. So if you had $100 in deposits, you could lend 900. Now, where did that money come from? Well, in short, they just kind of made it up. It came out of nowhere. But due to the nature of the fractional reserve system, not everybody needs their money at the same time, even when you're borrowing. So let's say I'm on a construction project and I'm renovating a property and I need access to a line of credit so that I can buy supplies. I need to buy lumber and cement, and I need to pay contractors. A lot of times, lenders will require that that sum is put into a bank account at their own establishment, which means the money didn't move at all, but you're paying interest on it. Beyond that, they're doing that times 9 or 10 times, a 10x multiplier of their deposits. So this idea of, I used to think when I was young, well, how does a bank possibly pay for all their bills and make any money at the end of the day, charging me 8 or 9%? Obviously, there's a spread. By spread, I mean the difference between what they pay people in interest and what they charge, but that just barely scratches the surface. That spread's minuscule. First off, what do they pay? Well, most checking accounts pay nothing. Savings accounts pay a abysmal 1/4% or 1/3%. I once had a banker try to tell me that 0.5% was really great, that it was the highest amount in the country or whatever. And I was like, wow, real fancy. So yeah, they offer mortgages, which tend to be on the lower end of the interest rate. something like 5, 6, 7%, maybe 8%, depending on your credit worthiness right now. And that seems small until you realize those are actually incredibly large purchases, and the average mortgage is 30 years. So you're paying on the full value of your home the highest amount of interest for 30 years. And that number is absolutely astronomical. Anybody that's bought a house and done the math realizes that by the time you're done paying for the house, you've paid for it several times over. The actual return is several 100%. It just looks like 3 or 4%. Okay, well, that's mortgages. Well, what about car loans? Car loans, the same kind of thing, except the interest rate's what? 10 to 14% right now, maybe 8 if you're lucky, right? But they can also repossess either of those assets. They're collateralized debt. So even after paying them several times your money, they could still take your asset and sell it again. Now, what about personal loans or business loans? Well, those rates tend to be even higher, pushing 20, 25%. And then we have credit card loans right at the top, which actually constitute a huge portion of a bank's debt instruments. Something like 25 to 30% of all debt in the US is consumer credit cards, and those rates are 20 to 30%. So when you really break it down, the actual base APR across all products weighted for as a weighted average, is probably closer to somewhere between 7 and 12%. That's their base rate. So if they made $12 on every 100, that would be something, but they don't. Interestingly, since COVID occurred, they have no requirements for a reserve at all. It used to be 10%, right? 9 times what their reserve was. Since COVID, that requirement's gone away completely. Now, that's not to say that every bank does that, right? Not every bank is fully lended that way, and there's certain regulatory requirements and assets and whatnot. But theoretically, and in a very real sense, that money can be lent almost indefinitely. But we're still not done. So if we average, say, 7 to 12%, let's call it 10% for easy math, and we multiply that times 10 because we're using each one of those dollars 9 more times. Well, that means that their actual base averaged APY is over 100% a year based on deposits that they have. Interesting. But it doesn't stop there. Let's take the idea of in-house transactions. Let's say I have a credit card and I use my credit card to purchase some food at the local grocery store or convenience shop. Well, if that convenience store or grocery store has an account at my bank, which is quite often the case with firms like JP Morgan Chase, Bank of America, these very large firms, it's a good chance that your merchant has an account and banks at the same place you do. Well, what happens then? Literally nothing. The money doesn't move at all. It's just accounting. They take it from me and they give it to this guy. So in other words, I'm still charged the interest, but the money didn't leave the system. In fact, it's counted as a new deposit. So money that I took on debt that is already lent at 9 or 10 times their deposits, so they're getting 10 times the return, is leaving by way of payment and then is coming back by way of new deposits for the merchant. The merchant deposits my $100, and that $100 is lent out 9 or 10 more times. And it happens over and over and over. So now assume the merchant is paying the supplier. If they bank at the same institution, it's getting deposited and marked as fresh deposits, and it is lent 9 or 10 more times. You're getting the picture? The real percentage rate for this is in the several hundreds of a percent. So I wanted to show you this here. So I said, let me run this through ChatGPT and make sure I've got this right. Here's the setup. The average interest yield is a loan APY of 7 to 12% per year across all loan products. The base deposit multiplier is 10x. That is the old 10% reserve model. It could be higher than this. We're going to redeposit a fraction per cycle. So this is money that comes back into the same bank. This is the merchant that has the same bank that you do. This is the supplier that has the same banking institution as the merchant. And we're going to assume that just happens 4 to 5 times. So each time, 65 to 80%, we're going to call it 70% of the money leaves the bank. Leaves, we'll just say JP Morgan Chase. Goes to other banks, they have to pay it out. But a small portion here, 20 to 35%, comes back around and just shifts hands, but is marked as a new deposit. So imagine the bank receives $1 in base deposit. Well, by the reserve ratio pre-COVID, they could lend out nine. They 9x their revenue. So that $9 earns on average 10% APR. The interest income first round is 90%. But if 5% of that is loaned money, returns as new deposits, then that's $2.25 in new deposits, internal deposits, which can themselves support another $20.25 in new loans, a 9x multiplier again. Each new loan also earns 10% producing, which is $2.03, et cetera, et cetera. So if we run that for just 4 to 5 cycles, now naturally there's no limit to these cycles, but if we run this for 4 to 5 cycles, we get the following income. If you add them all up, that's $3.50 to $4 in annual interest income for the first dollar. So that's 350 to 400% annualized returns on the base reserve. That is before operating costs, defaults. You say, well, where's all that money going? It goes to all sorts of fucking shit. It goes to the brick and mortar location and the real estate, paying rent there to be in the strip mall for the bank. It goes to the electric bill, but remember, some of those electric bill people probably have accounts with them. It goes to paying the tellers and the bank managers and the loan officers and the traders and the investors and the executives, et cetera, et cetera, et cetera. So if you cut all that crap out, you're left with a potential 350 to 400% annualized return on base deposits. And that's essentially the same thing that Better Bank is doing. That is a fractional reserve system. Better Bank doesn't have a brick and mortar location. They don't have an electric bill. They don't have tellers. They don't have, and they also don't have hundreds of billions of dollars, right? I think the total TVL we're working out with right now is 15 million or something. We're itty bitty tiny, even for a small town credit union. We're considered nothing, and that's where it's currently feeling its squeeze, with depositors trying to withdraw. This makes it harder because we're now seeing a situation where, under a normal condition, not everybody needs their money at the same time, and therefore people are able to save and earn interest for a larger purchase. And down the road, maybe you want to buy a car, or you want to put down a down payment for a house or whatever. Well, not everyone's doing it at the same time. The system works just fine. If you're wondering, how does Better Bank compare as far as its comparable fractional reserve? The max fractional reserve for Better Bank is 5x, not 9 or 10x. Interesting. In the wild west of DeFi crypto, we are almost twice as conservative as the fiat banking system. On top of that, inside of fiat, you're constantly being debased as well. So your bank is making 300 to 400% off of your back, while paying you a measly third to half of a percent if you have a savings account, and nothing if you don't. On top of that, they're charging you overdraft fees and account fees and management fees. And then, of course, if you're a trader, there's all of those fees related to all of those instruments. And they take and they take and they take. And that's how you see bankers making multiple six figures a year and playing golf through the entire week while you and I slave away at work. Better Bank cuts all of that out. It takes the same system of a fractional reserve system in which 20% of deposits are always maintained liquidly, and it allows the rest to cycle over and over. And then it incentivizes wildlanders to use that to manipulate the price, as far as to push the price of favor up when it's too low, or to drive the price down when it is too high. It's a self-leveling system. The Stronghold deposits are collateralized by loans in the wildlands. Those wildlands are collateralized with LPs. If and when those loans are no longer sufficiently collateralized due to a change in value or an accruement of interest, they're liquidated to repay the Stronghold plus interest. The wildlanders, on the other hand, are encouraged, incentivized, and essentially paid to manage the entire system. When the system's running a bit hot and all of the favor tokens are trading at a multiplier over the core system over 3x, so maybe 3.5 times the core system, the interest rate scales with it. And the interest rate rises in the wild lands, which causes liquidations of those collateral bits, which get returned to the strong hands, to the strongholds. Strong hands, yeah, strong hands in the stronghold. Strong hands in the stronghold. I need a t-shirt. Um, Likewise, the at those moments when all of the funds are utilized, so 80% of the stronghold is utilized with a 20% reserve, a 1-to-5 ratio, then there's nothing more for the wildlanders to borrow against in order to drive the favor price up, which means the only thing that they can do with their daily income is sell it down. It doesn't make sense any longer to form an LP, borrow against it in order to drive the price up. They're no longer incentivized to do that. It makes sense because they're not able to borrow. It makes sense to pay it down. And so they sell the price of favor down. This then reduces the price of favor, which is what the LP is made of, which causes the LP to become liquidated again, replenishing the stronghold. Once the stronghold has either new deposits or the replenishment from the old loans, then it immediately can be used again in the same way that once you've made your first payment for your mortgage or your car loan, that yet again can be lent out another 9 or 10 times. So it's the same system. So anybody that's like, oh, this isn't sustainable, it definitely is. You're just getting ripped off too often to know it. So you're getting ripped off, and BetterBank cuts out all of the middlemen, all of the physical infrastructure as far as a brick and mortar location, and most of the cost, and it compensates you in a variable asset that's not constantly being debased, right? Instead of a stable fiat that is reducing its value with inflation, you have a variable, a volatile asset like Pulse, PulseX, PLS, etc., that then has the potential for upside on top of the activity that you're doing. And in many cases, like the case of PulseX, is deflationary as well. Pulse is also deflationary by way of pump tires. So there's so many better things about BetterBank, and I feel like there's a lot of confusion about that. So I hope that kind of makes sense. I hope that helps you kind of understand that this is not a new system. It's quite an old system. It's just the powers that be have never put you in the banker's seat. And in BetterBank terms, you are put in the banker's seat. To give you an analogy, stronghold depositors are like depositors of the bank. They deposit and they earn high interest. At BetterBank, that high interest is quite high because all of the middlemen and all the minutiae is cut out. Wildlanders are like the bankers. They decide what loans get made, and they're rewarded for it. By making loans and driving the income generation of the bank, they are rewarded. They are driving the economic machine, and they're rewarded by their activities essentially for selling down favor when it's too hot or buying it up when it's too low, or building LP when it needs to be thickened, or liquidating LP by selling down favor when the stronghold needs to be replenished. The Esteem token is essentially the stock, the ownership token of the entire system. By buying Esteem, you're buying a piece of the action. You're speculating on the future success of BetterBank. You're betting on the fact that people will see this, deposit their funds, which pours gas on the fire, right? Now we have that flywheel. New deposits means we can use that money 5 more times. That 5 more times goes into the system. The system eventually gets liquidated or returned. That goes back to the stronghold, and the cycle repeats over and over and over and over again. That's why we call it looping. I hope that makes sense. I hope that helps you understand how BetterBank is truly better. It's better in a number of ways. The other thing that fiat banks have to worry about is default, or the majority of debt is not truly collateralized. And even when it is, it's collateralized by real estate or an automobile or something. There's real cost to repossessing that, legal processes they have to go through. And oftentimes banks take a loss, and that loss is part of their operating cost. At BetterBank, we're over collateralized. So the chance of there not being solvency or taking a loss is very low. So we're over collateralized where fiat is not. BetterBank only offers a max of 5x deposits rather than 9, 10, or unlimited times the fractional reserve. So we're more conservative. BetterBank offers variable or volatile assets like Pulse, PulseX, and PDI, as well as a stablecoin EDI to earn these interest rates on. BetterBank cuts out all of the middlemen, all the minutia, all the physical infrastructure, and all of the costs, which siphon those profits away from the people, and they pass them along to you, the Stronghold. I hope that's helpful. If you have any questions, let me know. But these systems do work, and BetterBank is doing something really revolutionary. It deserves your attention. How does this all fall apart? Well, there are a number of checks and balances in BetterBank that keep the system from collapsing completely. What it means is if you are a Stronghold depositor, you don't plan on using that money right away. And this is where a lot of people have gotten mixed up. People kind of tried to drop it in, pull it out without realizing it's going to be lent. That lending process is the machine that creates your APY. If you're trying to come into BetterBank, put something in, pull it out every other day, you're going to find yourself sorely mistaken. And one day that might not be possible. At least it may be possible for a little bit. You may need to wait until there are liquidations, which return that capital to your deposit, or until there's new deposits, replenish your part. That is the nature of a fractional reserve, and you need to understand that before you come into that. If you're fine with that, which, by the way, you're fine with it every time you operate with a conventional fiat bank, works there. If you're fine with that system, there's no difference with BetterBank except for what you can earn. So if you have questions, let me know. My name is MoteItBe Steve. And that's a brief example of the sustainability models and the parallels between BetterBank.io and fiat banks. I hope you enjoy.
No, but you're thinking of this place all wrong, as if I had the money back in a safe. The money's not here. Well, your money's in Joe's house. That's right next to yours. And in the Kennedy house, and Mrs. Maitland's house, and 100 others. You're lending them the money to build, and then they're going to pay it back to you as best they can. We can get through this thing all right. We've got to stick together, though. We've got to have faith in each other.
I can get along with 20 all right.
$20, fine.
And I'll sign the paper.
You don't have to sign anything. I know you. You pay when you can. That's okay. All right, Miss Davis.
Could I have $17.50?
Sure, of course you can have it. You got 50 cents?